Everyone in the UK has an allowance, an amount of money you can earn tax-free before you start being taxed. Everyone in the UK is allowed up to £60,000 per annum in their pension. That's the maximum you can get tax relief on. Your tax bracket determines how much personal savings allowance you get. Now, we've had people in the one-to-one session come with their ESR from 2 previous years. You can work out how much you have put into your pension, but basically it's 23.7% of your income. That's what your employer puts in, while they deduct 12.5%. But your ESR is important because you can get your total reward statement and work out what we call pension growth. Right, so welcome to the Moneywise Doctor Masterclass. It's 8:05 now. We're just going to do a brief quiz for 5 minutes and then we're going to delve in. Today is 10th of September, and like I said, 706 people signed up for this masterclass. We're going to pack it full of value. So if you've never met me before, I'm Dr. Andy Egwim. I'm the former salaried GP. I'm the founder of Moneywise Doctor. I've been an investor for 20 plus years, and I started Moneywise Doctor in 2023 to share the lessons on my journey to financial freedom that allowed me to leave my salaried job 3 years ago. And since then, thousands of doctors have actually used our resources, our guides, and Moneywise Doctor to make smarter financial decisions around tax, investing, financial protection, insurance, and just generally being financially in control of their lives and not just sort of being under financial anxiety all the time. But to kick off, I'm going to give a brief quiz. At what age can you no longer open a lifetime ISA? This one is a simple one. Yeah, good. Yeah, 40. I don't see anyone failing that one. Okay, let's make it a little bit more interesting. So the next question, number 2, what is the maximum amount of money you can put in a lifetime ISA in order to get the maximum benefit? So Evelyn said 20, Arinza said 4,000, Shady said 20,000. Okay, right. So very good attempts. Everyone participating. The thing about this whole masterclass is you get the most out of it based on how much participation how you're engaging. So the maximum amount you can put in your lifetime ISA to get the maximum benefit is £4,000. So that £4,000 is 25% of it is £1,000. So you can put £4,000 in a tax year and you can get the maximum benefit from the government. And of course, as you know, you can invest a lifetime ISA. You can either save it and use it for buying your first home, or you can save it for retirement, or you can invest it for retirement. But the fact about it is you can't get it till you're 60, or you can get it before 60 if you're using it to buy your first home. However, once you've crossed 40, you can't open the lifetime ISA again. Now, this one is a false statement. It has A, B, C, and D answers. Which of the following statements about interest from your savings account is false? A, your bank or building society automatically reports the interest you earn to HMRC. B, the interest from your savings account may be taxable if it exceeds your personal savings allowance. C, HMRC may automatically increase your tax by changing your tax code to collect the tax due on savings interest. D, interest generated in a savings account is never taxable. So which one is the correct one? I'm looking at the chat. Oh, wow. Okay. Lots of people here. Very good. Well done. So I've seen D. Simpson said D. Arinza said D. Akin said B. And Ngozi said A. Right. So the correct answer. Okay. Lots of people. Yeah. Vidya said B. Emmy said A. And same. Okay. So excellent. Well done, guys, for your participation. Albert has used the trick. He said from med school, any option with never or always is false. That's a good hack, Albert. Right, but he's right. The answer here is D. So if you look at the options again, A says your bank or building society automatically reports the interest you earn to HMRC. That is correct. Your bank, by law, with the new legislation, your bank or building society now reports whatever interest you earn. They report it to HMRC. Every interest you earn. So the HMRC doesn't need to ask you to declare it in your self-assessment. They just need to check if what you declare corresponds. B, the interest from your savings account may be taxable if it exceeds your personal savings allowance. That is correct. So in this case, is the wrong answer because it's correct. If the interest from your savings account exceeds your PSA, and if you've been to my master classes, you know PSA does not refer to prostate specific antigen. It's referring to personal savings allowance. If you exceed the personal savings allowance, then you would have to pay tax on the excess interest. 7. There are 7 steps to take before you even start thinking of investing as a doctor or healthcare professional. Now, this is really important to secure your financial foundation before you start investing. Now, I've covered these 7 steps in a simple guide that I've made available for you in the link in the description. You can download it. It will help you to build a solid financial foundation, avoid common investing mistakes, and also make tax-efficient investment decisions. Start your investment journey the smart way. Download the guide now using the link in the description, and good luck on your investing journey. Now let's get right back to the episode. And who can help me here? What was the personal savings allowance for someone who is an additional rate taxpayer? So an ART. If you're an additional rate taxpayer, meaning your income is in excess of 125,104. What is your PSA, your personal savings allowance? I've got some really brave, smart people here. Priya said 500. Arinda said 500. Shady said 0. So well done, guys. Ade said 500. Again, it's not about getting it right. It's about participating and learning. If you get it wrong here, but you get it right in your finances, then you'll be a happy person because you'll be more tax efficient and then you invest smarter. Okay? Evelyn doesn't understand the question. So don't worry, Evelyn, we'll explain it throughout. So the answer to that is 0. The answer to that is 0. So there's something called personal savings, your PSA. I'm sure most of us haven't heard about it, and some of us already know. For any money you save in your bank, any interest you generate is taxable to a certain level. So even what that means is that if you take £20,000 and just deposit it in a regular savings account and it's yielding you, let's just say 5% returns, okay? You're getting 5% returns on your savings. So that £20,000, what will 5% per annum give you in interest? Evelyn, do you want to have a go at it? Okay, Evelyn says 500. Okay, Ade says 1,000. Okay, so it's £1,000. So 5% of 20,000 is £1,000. Correct me if I'm wrong. Basically, that's 5% of 20,000. The problem with that is that in the UK, there's a personal savings allowance, and it's based on what kind of taxpayer you are. Now, if your income is less than £12,570 per year, which is no doctor practically earns that. But if your income is less than 12,570, or maybe you're a company director and you just take a salary, or you're a pensioner and you just take an income of 12,570, you pay no tax. If you are a basic rate taxpayer, that means your income is above 12,570, but is less than £50,270. So that makes you a basic rate taxpayer and you pay 20% tax. Okay. Now, if your income exceeds £50,271, you are now a higher rate taxpayer. So any income above that is taxed at 40%. Okay. I'm sure that bit is clear. Some of us are already in that bracket. Now, there's another level called the ART, the additional rate taxpayers. If your income exceeds 125,140, anything above that is taxed at 45%. So basically, your tax bracket determines how much personal savings allowance you get. Okay? Evelyn, is that bit so clear? Yeah. So basically, your tax bracket determines how much personal savings allowance you pay. So if you're a basic rate taxpayer, your personal savings allowance, how much interest you can earn tax-free, is £1,000. Okay. So how much interest you can earn tax-free is £1,000. Now, if, for instance, let's say you're a higher rate taxpayer, then how much you can earn tax-free is only £500. So Evelyn, in this instance, if you put £20,000 and you get interest of £1,000, that means you're owing some tax to HMRC because you allow 500. The other 500 is now taxable. So that's why people get surprised. How come if I just put some money in my bank account, it turns out that I'm owing HMRC just for putting money in my bank account. So this is part of what could happen with savings. Go back to those options. C said HMRC may automatically increase your tax by changing your tax code to collect a tax due on savings interest. That bit is correct. And then interest generated in a tax account is never, in a savings account, is never taxable. That is wrong. So that makes it the correct answer. Okay. Who is up for one more quiz before we go? One more quiz before we crack on. We'll just do one more. I think the quiz is, they help us to limber up, help us to get ready, and then help us to, get into, switch from your clinical brain to your financial brain. Okay. Let's look at SIPP, self-invested personal pension. Let's assume that you don't have an NHS pension. What is the maximum amount you can put in your self-invested personal pension in a tax year in order to get tax relief if you are a basic rate taxpayer? Okay, very good. Someone says 40K. Ada says 40K. Abdul says 40K. Ade said 60K. Albert said 20K. I think this one is a bit unfair, but I'm going to explain to you guys. But it's a place where a lot of doctors out. Like most times, they don't realize it. They fall into this tax trap. So it's something we're going to pick. Judge says 20K. And yeah, Femi said, I don't know. And if they said I need the SIPP knowledge, okay, right. So everyone in the UK is allowed up to £60,000 per annum in their pension. That's the maximum you can get tax relief on, and that 60,000 includes your NHS pension. For those who have got NHS pension, if you're lucky to have NHS pension, that's brilliant. It includes any money you put in your private pension, whether it's a SIPP, a self-invested personal pension, whether it's a SARS, like small self-administered scheme, or even if it's just a private pension. Altogether, the maximum you can put in a tax is 60K. And now I understand that not everyone puts in up to 60K. Many people put in far less than that. But knowing that at all means that if you find yourself in a tight tax-wise, that could be your option to actually put some money in your pension and then invest it rather than overpaying tax. Now, £60,000. Imagine you are already an NHS consultant or you're a registrar or SHO. The NHS pension, your employers are already contributing to your pension pot. Okay, we know that already, don't we? So that's why when people pull out of the NHS pension, that means your employer doesn't contribute anything anymore. So you yourself, you are also contributing to the NHS pension, and that is why there's some tax-free money. For instance, if you get your pay, before you get your pay, have you ever looked at your pay slip? If you look at your pay slip, did you ever NHS pension deducted? Anyone here? Okay, good. So that NHS pension is deducted before tax. Okay, so it's entirely tax-free, and that's part of what makes up that 60%. So imagine in a tax year, maybe you're a consultant or even you're a GP, and your NHS pension so far, you've put in up to, the growth in it is up to £40,000, including the amount that's been put in by your employer, including the amount that's been put in by yourself. Usually the highest level will be 12.5% of your salary going into the NHS pension, and your employer is putting in about, let's say, 23.7%. Okay, now let's say you have £40,000 from your NHS pension. Remember, the maximum you can put in a tax year to get tax relief is how much? £60,000. We want to get the most out of this session. So that means if the pension growth in your NHS pension is 40,000, basically you have £20,000 that you can still contribute. Is that correct? Is that true or false?
True.
So that's false. Sorry, that's false. So you can't just put another £20,000. Good attempt for trying, Sim. But you can't just put another £20,000. Can anyone tell me why? Why you can't put another £20,000 to get to 60? Anyone at all? Anyone? Even if you've been in the 4 weeks investment masterclass or my mastermind and you know this answer, feel free to volunteer it. Okay. Employer contribution. Yeah, we've already counted that. That was the NHS pension, employer contribution. I'll tell you why. Guys, is also one of those questions that little things are not obvious. That's where people fall into traps. Because I had a doctor come on social media. She was very upset. She exceeded her pension allowance without doing anything. She just got a letter from HMRC to say, you've exceeded your pension allowance. So how can this be my fault? And there was a penalty for her. Why? Because there's a tax relief. So if you're a 20% taxpayer and they tell you can put up to 60K in your pension pot, that means that you can put up to 60,000 including the tax relief. And the tax relief for you as a 20% taxpayer, a basic rate taxpayer, is 20%. I'll explain it again. What that means is that, for instance, myself, because I don't work in the NHS or I don't work for anyone, I work for myself, I'm still allowed 60,000. If I go and say, well, I'm going to put £60,000 direct into my SIPP, that will create some problems for me. Why? Because let's assume I'm a 20% tax rate payer. I'm going to get 20% of whatever money I've put in my pension added to my pension from the government. So if you put money in your SIPP, they're going to give you tax relief based on your marginal rate. So if you're a 20% taxpayer, you're going to get 20% tax relief. So that means that if I want to get to 60K, I put in 48,000. Okay, so if I put in 48,000, by the time they add in the tax relief, I can get to £60,000. Okay, so that's how to work these things out. But the big question some people will ask is, how do you know what your employer is contributing? So anyone knows is a simple one. And if you've been in our Moneywise Doctor community or you're in the mastermind, you know this one. How do you know? I'm reading some of the comments. They're really funny. Someone said Wahala. Someone said payslip, TRS, headbanger. Priya, well done. Priya got the correct one. So your TRS is where you see your total reward statement. Now, if you work in a trust, you can easily get this. You log into your total reward statement through your, what's that thing you guys log into? You can log into, if you are in an NHS trust, your ESR. Thank you, Sim. Your ESR, you can get your total reward statement. Now, we've had people in the one-to-one session come with their ESR from 2 previous years. You can work out how much you have put into your pension, but basically it's 23.7% of your income. That's what your employer puts in, while they deduct 12.5%. But your ESR is important because you can get your total reward statement and work out what we call pension growth. So you can know what is left to put into your pension. Now, someone might wonder, why are you interested in finding out how much more you can put into your pension? Why is it even important? Why is it important? Does anyone want to have a go?
It helps you maximize because it's taxed before you are being taxed, so it's pre-tax. So
Right.
it help you so you have less money that is being taxed in the end.
Excellent. Look at how I'm beaming proudly because Anthony is currently in my financial coaching program. Yeah, so that's it. So why do you do it? Let's say, I'll give you a scenario. Let's say, Kayode, I'll just use an example because you look distinguished. With your glasses, you look like you're a really good doctor. Let's just assume that Kayode is a doctor and Kayode is earning £125,000. Or let's just say £126,000. What could be the problem? Kayode is a hardworking doctor. He deserves this pay. He's been in the medical field for 20 years. But guess what? First of all, he's no longer in the basic rate taxpayer because his income is above 50,271. He's no longer in the higher rate taxpayer because he's exceeded 125,140. So Kayode is being taxed at 45%. But that's not the issue. The issue now is what I mentioned earlier on called the 60% tax trap. So everyone in the UK has an allowance, an amount of money you can earn tax-free before you start being taxed. You're aware of that, right? Okay. Now, when Kayode crosses 125,140, for every £2 he's earning above that amount, every £2 above 100k net income, he starts losing £1 from that tax-free amount. Okay, I built a whole calculator just to explain this thing. So earlier in the year, last year, I built NHS salary calculator. So you can play with it. If we go into NHS salary calculator, we will never finish today. Someone from my team has shared it.
Yes, here's something quick and useful. If you ever wonder what your actual take-home pay is after taxes, NI, pension deductions, or you just not sure how paying more into your pension will affect your take-home pay, our free NHS salary calculator will give you a clear, instant breakdown. It's perfect for planning your finances, checking deductions, or even spotting overpayments, and helping you determine how any changes in your pension contributions can affect your take-home pay. You want to make sure you're taking enough home. Now, it's easy to use and it's tailored for NHS professionals like you. You can try it now for free on nhsSalaryCalculator.com. So it's nhsSalaryCalculator.com. The link is in the description. Now let's dive right back into the episode.
And if it's something you're struggling with, bring it up. If you join the WhatsApp community for free, we can play around with it. But the NHS salary calculator, it will show you clearly that for Kayode, it will show you how his tax allowance is disappearing. For every extra pound above 100k, every extra £2, he loses 1k. So by the time he hits 125,140, he's lost the entire tax-free amount, and therefore he's paying an effective tax rate of 60%. So what can Kayode do about it? Kayode might say, you know what? I don't feel like paying 60% tax rate. I'm working too hard. That's if he knows. Because for many doctors, healthcare professionals, they don't find out. They just think, why is HMRC saying I'm owing them the money? Because money is being deducted, the tax is being deducted, the pension is already being deducted. How come they're still writing me that I'm owing them? And why am I have a huge salary, but my take home is so low? But if he knows, what he could do is he can decide, you know what, I'm going to reduce my adjusted net income. Therefore, reduce my taxable income. And one of the ways, there are 10 ways, and I've written a free guide about it. Someone from my team can share the guide, how to avoid the 60% tax trap. But basically, the number one way, the best way we've seen is increasing your pension contribution, making sure that you are using the whole £60,000. So for instance, Kayode can decide, you know what, my NHS pension pot is showing that my pension growth in this tax year is £40,000. So I can put in an extra 20,000. Okay. He will not do 20,000, obviously, because he's going to get tax relief. So because he's a 40% taxpayer, he might even go ahead and put in an extra 8,000 or 10,000, and that can reduce the adjusted income. Now, he can even go ahead and put more than 20,000, because why? You are allowed 60,000 in a tax year. But if you missed last year, you didn't use your 60,000, and you missed last year, I can see Kayode and Sim. I'm like, okay, yeah, they're getting my point. So you can do what we call carry forward. Now, tax language can be confusing. Carry forward means moving backwards. Carry forward means you can go back and use up the allowance from the past 3 years. So this year, last year, and last 2 years. So your allowance is not going to be 60,000. It's going to be 180,000. So when you do that, you reduce your taxable income. But where does the money go? It goes into your personal pension. And remember what it's called, SIPP, self-invested personal pension. That means you can now invest it by yourself. Now you can only invest it in stocks and bonds. You can invest it in property. That's another depth of discussion, obviously. But stocks and bonds, whether you want to buy index funds, individual stocks, whatever. But at the end of the day, rather than the money going as an extra tax, is going into your future. So rather than paying extra tax, you're paying into your future. So that's why Kayode might want to work out what is his tax allowance and how much you can put. Right. So what I'm going to do, I'm going to share the PowerPoint, you know what, but like I say to you guys, is not death by PowerPoint. It's just basically to help us keep us on track, you know. Thank you guys. I can see from my team, some people have shared the link. Yeah, guys from my team have shared the link to the 60% tax trap. And yeah, Sonia, thank you. I hope you find it helpful. Don't worry, you can download the guides later. And for those of you who have signed up, you can share the links to the guides as well in a follow-up email. So watch out for my email. Make sure you drag it into your inbox, or it might end up in spam. And I've got people messaging me, asking me the link to join this session because it's going to their spam. That's why they missed it. Okay, so I'm going to share my slide in a minute so that we can crack on and get into it. So why did I start with taxes? You can see it started with taxes. We've not even delved into investing. Why? Because tax can be an easy win. If you get your taxes correctly, that means you started winning even before you started investing. Okay, for instance, if you are tax efficient, let's say you start investing and you have your tax sorted out, you are using an ISA, you are using a SIPP, okay, let's say you're in Canada, you're using your TFSA, you're using the right account, because we have people from Canada joining the sessions, and some of them wake up by 5:30 a.m. to join our master class and academy sessions, and they'll tell you that the knowledge they've got from ISA, they look for the same type of accounts when they get to Canada. Then you are already tax efficient, you are already in an advantage, because if you are investing and you're paying 20% tax and I'm paying 0 tax, even before I've made any investment, I'm already in a good position. That's why I started from tax efficiency. So Kayode says, this is eye-opening. Yeah, thank you, Kayode. Tunde say, can I pay more into my workplace pension rather than opening a SIPP? Yes. You can decide to increase your workplace pension. It's called salary sacrifice. Okay. So if anything is unclear to you, don't worry. We'll answer the questions and make it clear. Because for most doctors and healthcare professionals, some of this you're hearing it for the first time. For me, I'm very careful. I don't want to jump into things. Like for those of you who have just finished the 4 weeks investment academy from July, you understand how deep we go when we go into investing, analyzing investing, tax efficiency. And those are the kind of things that are like, it's bread and butter for me now. But most times when I teach them, I see people like, wow, I didn't know this. Oh, I didn't realize I could do that. So that's why we want to start from the basics, because why for me it might be boring now and it's bread and butter. But if it can save you 20,000, 30,000, 40,000, or even help you avoid a heavy tax bill, then I'll be delighted and I would have done my job. I've had colleagues and friends who received surprising envelopes, brown envelopes from HMR to say, oh, look, you're owing us some money. You're owing us 22,500. And they wonder how. And it turns out that, look, they didn't realize that they were underpaying tax. They didn't realize they were falling into the 60% tax trap. Hardworking, honest people. And some of them said, okay, I started paying. But some people said, you know what? Look, I'm going to have to make use of the legal means available to me so that I can be tax efficient. That way you're working hard and your money is working for you. All right. So, so far, so good. Who here has heard about the 60% tax trap? If you've heard about the 60% tax trap before this session, or maybe you read it from my content or from my video, just give me a thumbs up. Thank you, Vida. Thank you, Sonia.
This could save you several thousands of pounds, not just in your taxes and pensions. Have you fallen into the 60% tax trap as a doctor or healthcare professional without even knowing? It's crazy. I know you think the highest tax you can pay is 45%, but here's how it works. If your income exceeds 100,000, you start to lose your personal tax allowance, and by the time you hit about 125,000, you've lost your entire tax allowance. This means you're paying an effective tax rate of 60%. That's not good. You lose a lot of other benefits with it. Now, if it's something you've never thought about or you're worried you're not sure how to navigate it, you're in luck because I've written a very clear guide with a 10-point checklist that you can use to avoid the 60% tax trap. One of the biggest one is obviously paying more into your pension, but there are 9 other steps you can take. Check the link in the description and download it for free. Let me know if it helps. Let's jump right back into the episode.
Who had never heard about it? This is the first time you've heard about the 60% tax trap. Yemi said kind of. Evelyn said, yeah. Sissy said, okay, yeah, okay. A few of us haven't heard about it. Good. Thank you for your engagement, guys. When I started publishing articles and posts about the 60% tax trap, so I've made 700 videos on investing, personal finance for doctors, and tax and financial strategy. I've made 700 videos. They're all on YouTube. You can watch them. They're totally for free. But I also wrote guides on the 60% tax trap. And when I first published it, and it was ranking number 1 on Google, so many people were like, this is crazy. Why has nobody told us about that? I'm like, there are 100 other things that nobody tells us as doctors, and we're too busy doing the noble thing, saving lives. And unfortunately, the same doctors are working so hard for other people sacrificing. Unfortunately, the system has a way of, just messing us up. If you're not investing, you're not tax efficient, nobody really even tells you anything about it. So guys, that is just a tip of the iceberg. I think we're beyond introductions now. So obviously, you know what class you are in now. And the Moneywise Doctor, I founded it in 2023. I've told you a little bit about it. And we provide financial coaching for doctors, financial education. And part of what we do, we provide guides and just to make finance as simple as possible and practical for doctors. In addition to that, we also work with strategic partners, like if you need to work with mortgage advisors or insurance advisors, or even if you want to work with regulated financial advisors for products, we vet them, and then we can say, well, these are the ones that understand working with doctors and healthcare professionals. Why? Because they've worked with several doctors and had the reviews, and they understand what it's all about. We also work with those as well. One of the things we notice is that a lot of traditional financial advisors don't understand the real issues with doctors' finances. For instance, NHS pension. Many people don't understand how the NHS pension works, because most pension in industry, if you talk to a banker, their pension is defined contribution. Is a different type of pension. You put in money, your employer puts in money, and the money is invested. Now, NHS pension is defined benefit. Quick question for you guys. Tell me in the chat. Your NHS pension is being invested carefully. True or false? Tell me true or false in the chat box. Your NHS pension is being invested in the stock market by able managers. Okay, lovely. I've got a few responses here. Thank you so much, guys. You're keeping the session active. Priya says false, and Donna said true. Who else? I'm reading some other comments here. Sorry, guys. Okay, so Iris says true, false, false. Right, thank you, guys. So the answer is false. Your NHS pension is not being invested. So the NHS pension, like most public sector pensions, is defined benefit. Now, I'm not going to call it MLM, or I'm not going to call it like Ponzi or anything, because people get upset. But basically, how it works is that Kayode contributes to the NHS pension, Tokwe contributes to the NHS pension, and when is their turn to take the pension at 65 or whatever age your pension age is, you collect your pension, and the other set of people keep contributing. So you better hope and pray that people keep contributing to the NHS pension. So that's defined benefit. It has its advantages. It has its downsides. One of the advantages, obviously, is that you're not taking any market risk. The money is not being invested. The money is tracking inflation, so it's index linked, it's rising with inflation, and it's salary for life. but you don't have a say where the money goes. Unlike my SIPP, my self-invested personal pension, I can invest it in any company I want. I can invest in index funds. I can invest in individual companies. But the downside is that with SIPP, you need to know what you're doing with investing, or at least know how to reduce your risk. You don't need to be an investing guru. You're a busy doctor. Not everyone needs to do discounted cash flow analysis and analyze companies like I do, or like the kind of things we teach in the 4 Weeks Academy. You could actually set and forget an index fund portfolio, buy a broad, well-diversified passive portfolio, and I'll explain those things, and set it automatically. So you're not going to outperform the market, you'll be average. But guess what? If you get the average market performance over the next 10, 15 years, you're going to be very fine, and you're going to beat 99% of active traders. You're going to do better than them. Well, I can't see the future, but if we base it on the data from the past, 99% of active money managers fail to beat or to do better than the average market index using the S&P 500. Okay, so you know a little bit about Moneywise Doctor. The YouTube channel is out there. You can have a look at the podcast as well. Okay, so a few other things. So about me, I think you're probably bored to hear about me now, but just in case anyone is asking, you can check me out on Facebook. I'm Dr. Andy Egwim, UWC Andy Egwim. I'm the founder of MoneywiseDoctor.com, and I was that guy in medical school that the consultant and my colleagues would want to ask questions about investing. And even back then, I taught seminars on investing. So investing and entrepreneurship helped me to achieve what people call financial independence about 3 years ago, and that allowed me to say goodbye, salaried employment. So like I always say, I still don't own a Ferrari, I don't fly any private jet, but I just own total control of my time, so I can decide what to do with my time, including just being back from a 6 weeks holiday, 2 of which I spent abroad in Nigeria. So having that freedom to decide to work on projects like that is what I value the most. I still have my license to practice as a doctor, and I do enjoy working as a doctor on the days I have the privilege. Sometimes it's just chatting. When you're a JP, you're chatting with an 80-year-old telling you what they were like at 25. Being able to, yesterday, I think I was supposed to be on a podcast. I eventually went, but they will call me from nursery to say, oh, your child is sick, come and pick them. Not having to stress about, oh, do I have to call work and all that? Now, I'm not saying that to tell you that I've arrived. I'm just trying to expose you to what is possible if you start now. Because someone said, I wish I started 20 years ago. I started at 19 myself. But when you should start, the best time to start was 10 years ago. The next best time is now. And how do you start? First of all, block your tax leakages. Make sure you're not leaking money through taxes. That will give you more money to invest. Before you start to invest, you block your tax leakages, and that's what we are discussing this evening. And then set up safety nets before you start investing so that you don't sell during a downtime. So I've been to 3 stock markets. My first stock market crash was 2008 crash. I was a medical student. It was very eye-opening. It made me understand human nature. And people think if the market crashes now, I'll go and buy Google. I'm going and buy Facebook. Really, it doesn't really work like that. Everybody's scared. Okay, so I saw 2008 market crash. I was fortunate, didn't lose money, but didn't make any money because I was scared to invest. So I was ready in 2020 when the COVID pandemic came. Of course, everyone was still scared, but you're thinking, well, if I invest this money, if the world comes to an end, worst case scenario, money won't mean anything. But if I'm seeing this company is undervalued, I know that their free cash flow is very good, and I'm looking at this company, is a very good company, I'm going to invest in this company, it's totally undervalued. Worst case scenario, if the world comes to an end, nobody will need money. If the world doesn't come to an end, we're going to do quite well. So that's part of what helped me accelerate my journey to financial freedom. Well, I hope you found that helpful. And more importantly, I hope it helped you to see investing in a new light. This is just a small section of what we cover in the full masterclass. If you'd like me to drop more of these clips, just let me in the comments. Comment invest and share this video as well with friends who may need to hear this.
And if you are ready to stop winging it and guessing, guesswork is not good for investing. If you want to learn how to become a confident investor, to learn how to invest properly, check out our investing readiness scorecard with the links in the description. It will help you determine whether you're really ready to start investing and what you need to do before you even start thinking about investing to reduce the chances of you losing money. And until then, see you soon. Bye-bye.